Hello, everyone. Welcome to video 10 of Module 4. We are currently revisiting some of the tax credits we talked about in earlier chapters. In this video, we're going to revisit the foreign tax credit. One second as I share screen. Okay, so Foreign tax credits are an endeavor to keep people from being double taxed if they earn income from a foreign nation. Because the Canadian government's going to have that income reported and taxed on it, you may also had to have paid taxes in the country the income was earned. So now you're paying a tax amount on a certain income twice, one to Canada, one to the foreign country. So tax credits for foreign income are to recognize taxes that have already been paid and using those to reduce the amount of taxes that you would owe to Canada. So the foreign non-business income tax credit, we have to recognize the full amount of the non-business income earned, including the taxes withheld. That's going to be added to net income. So if we got a dividend of $100 and there was a 15% tax withholding, we only received $85. 15 was held. But we still have to report the full $100 to our income because the Canadian tax calculation is going to consider the full amount. Once they have the amount of taxes that are calculated, the amount withheld in the foreign jurisdiction will be credited against the tax payable. The thing is, the Canadian tax payable credit, this credit is limited to the 15% for non-business income. So 15% is generally the lowest tax rate for Canada. So they're not going to give a credit over 15%. Basically, the thought process is you can't deduct from Canadian taxes more than what the Canadian taxes would have charged you for that income. So any tax withheld over the 15%, you don't get a credit for it, but you will be allowed to deduct it from the income as an expense of earning that foreign income. So back to our example of if I had a $100 dividend and the foreign country withheld $17, my tax credit will be 15, but the $2, so $100, I would have received 83. So the $15 of a tax credit and that $2 difference will be considered an expense related to the income. So I won't report 100, I'll report $98 and then recognize that tax credit for the 15. 98 minus 15 gets us to the 83 we actually received. So up to 15% is the tax credit. Anything above 15% is treated as a deduction. So in the basics example, we receive $850 after withholding tax of 150. That means that the income was 1,000 total. We include the $1,000 in net income. The Canadian tax on $1,000 would have been $450. So 1,000 at 45%. The tax after the credit. So they withheld $150 and that is 15%. So the tax calculate says, okay, you owe $450 in taxes, but you've already paid $150 to a foreign nation. You've already paid those taxes. So 450 minus the tax already paid equals $300. So the total tax paid still matches that 450 that was calculated, but it gets split up. 150 was withheld from the foreign government, so Canada gets the remaining 300. Your overall tax outcome is the same as if it was earned in Canada and taxed fully at 45%. Now the withholding amount of 15% it's not always the correct calculation to say how much Canada would have taxed. So the credit equals the lesser amount, the actual amount withholding, the actual taxes that were paid, or foreign non-business income as a portion of your adjusted Division B income. How much of your Division B income was foreign non-business? That creates a percent. We apply that percent to the tax otherwise payable. That percent of the tax otherwise payable say, hey, you would have owed this amount This portion of it relates to the foreign non-business income. If that amount is less than 15%, let's say it's 13%, then that's what we're restricted to. You can't get a credit more than what Canada would have taxed the income on. Now, we mentioned a couple things. One is adjusted Division B income. So, Division B income is the calculation of our net income without considering rules such as TOSI. So, we have our net income, and from it, we're allowed to subtract pretty much the amounts related to capital gains and losses. So, capital gains deduction, we can subtract any net capital losses that were deducted. We can subtract any stock option deductions and deductions for workers' compensation. So we have our Division B income, our net income, and we're allowed to subtract from it our capital-based losses and our non-taxable worker compensation. Tax otherwise payable is the Part 1 tax payable before any deductions of dividends, employment outside of Canada, investment, political contributions, and sponsored funds. For business income, the individual includes 100% of foreign business income. Foreign taxes withheld are allowed as a tax credit against taxes payable. If foreign business income taxes exceed the credit, there's a 3-year carryback and a 10-year carry forward. So the tax credit for business income is very similar to our calculation for non-business. The big difference is business income doesn't have that 15% limit. Foreign non-business income is limited to 15%. Anything above is a deduction. If it's a foreign business income, any amount paid in taxes is allowed to be considered as part of the options. There's no 15% limit, but we still do the calculation. What portion of our adjusted Division B income is related to that foreign business? And that percentage tells us how much of the taxes would have been paid for that foreign income. So the tax credit can't be more than what we would have paid to Canada. If we did pay more, so let's say the foreign business calculation says 18% and we paid 20, that additional 2% we paid, the taxes we paid, can be carried forward and applied in a future year. But we just don't get the credit now. Taxes otherwise payable, less foreign non-business tax credit. Okay, so going to the exercise. In 2024, Sarah Chung has rental income of $44,000, net taxable capital gains of $2,500, and foreign non-business income of $3,500. We have several types of income. The foreign country withheld 11% of the foreign income tax, resulting in a net receipt of $3,115. So we had $3,500 of foreign income, but the foreign entity held 11% for taxes. She also claims 2 taxable income deductions, a $4,000 non-capital loss and a $1,000 net capital loss. Her only tax credits are the basic personal amount and any credit for foreign income. Calculate the 2024 federal income tax payable. Include a detailed calculation of the foreign non-business income tax credit and ignore the deduction that would allow any excess foreign income to be claimed as a foreign tax credit. So we're not going to worry about calculating the actual tax payable. We're just trying to calculate the foreign tax credit. So there's a couple steps in this. So one is we have to figure out our net income for tax purposes. So using that Section 3 calculation, we include our positive incomes, which is our property rental of $44,000. We have our taxable capital gains of $2,500 and foreign non-business income of another $3,500. So that means our total income is about $50,000. From our net income, we can subtract our capital-based losses, which was $1,000 that we're carrying forward. So our taxable capital gains for $2,500, we're applying our $1,000 carry forward. So our adjusted Division B is $49,000, our net income minus the claimed net capital losses. Non-capital losses of $4,000 means our taxable income is $45,000. Our tax rate is 15%, so our tax owing is $6,750 minus our basic personal amount. means our Canadian tax that it would have been payable is 4,394. So we calculated our income, we figured out what that tax payable would have been. Now we look at our foreign tax credit. So our actual withholding was $385. So we'd like to be able to claim that much, but we have to take the lesser of what we actually paid and our portion of our adjusted Division B income that relates to that non-business times the taxes we would have paid. So this calculates that related to the foreign non-business income and what we owe Canada, $314 relates to that foreign income. So Canada would have only taxed that income 314, but we paid the foreign country 385. So Canada's not going to give us the credit for 385 because they never would have gotten the 385. They would have gotten the 314. So this does not have an equal tax withheld. So our federal taxes payable is our 6,750 we already calculated. Those basic credits we included, plus we get a foreign tax credit of that 314. So our tax payable is going to be $4,080. So just to revisit, we calculated our net income, applied our losses. Our adjusted Division B is our net income minus our capital base losses claimed. That that creates our denominator. 3,500 of foreign non-business is our numerator, times taxes otherwise payable, not including the foreign tax credit. That portion says, okay, $314 is what Canada would have collected. Then we compare that to what did we actually pay? We paid 385. Okay, so we'll claim the lesser, 314. If we only paid $300, then we would only claim $300. So we compare these two, we take the lesser amount, and that credit gets subtracted from our taxes. Yes, so that is the last exercise that we need to cover for this course. I'm going to have one last video discussing the alternative minimum tax. It's a somewhat lower priority, but I will cover it in a short video. But be aware of these calculations that we covered so far and those restricted losses, how they apply to income, and those donations of depreciable property, as well as our foreign tax credit we calculated here. Thank you for your time. See you in the next video.